The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
You're listening to the Ascent with Crestmont Private Wealth. This is Alec Walker, EVP of Financial Planning, coming to you live from our Houston offices. We've had some interesting topics recently on the Ascent. We had Kellen Mond on with Sam talking about his art and photography business. We talked about, we're approaching the tax deadline. We had some topics discussing, things to be thinking about as we finalize our taxes and get beyond that into the rest of the year. And then today I thought I'd bring up something, again, a little bit more topical, given a kind of a quarterly market recap. Just this past week, we sent out our quarterly investment newsletter to our clients. And there's obviously headlines daily, hourly on what's happening with the conflict in the Middle East with Iran. As of this recording, kind of the latest updates was, the hope for peace talks, but kind of approaching, what President Trump's deadline is for Iran to come to the negotiation table. So by the time this is released, there could be some updates and changes. But as of this recording on April 7th, I wanted to give just a quick recap on what happened in markets in Q1. So obviously the biggest news is higher oil prices based on the conflict overseas. With our offices, here in Houston and out near San Antonio and Bernie, you can imagine we've got a lot of clients that work in and around the energy industry. So this is something we've been having some significant discussions with clients. Most markets have suffered as it relates to this conflict, but some of these energy companies have done good. They've performed well as the price of oil has risen significantly. It's kind of been hovering anywhere from $100 to $110 a barrel. But surprisingly, it's still a little ways off from where it was around $120 a barrel in March of 2022. So we still have some room to go to get to that level. Really, the biggest thing driving prices of oil is how that's going to impact inflation, and how then that inflation number is going to impact the pace of Fed rate cuts. So those rate cut expectations have dropped significantly. Coming into the year, the market was expecting at least 2 Fed rate cuts. With inflation kind of expected to be a bit higher with the surge of prices, we may be looking at 1 or 0 cuts. There have been some news and headlines about the possibility of rate hikes, but we think that would be a really significant hurdle for the Fed to actually hike rates right now. This would have to be a very prolonged price increase of oil. So we'll see how that turns out. As it relates to equity markets, so overall, the S&P 500 was down about 4.3% through the first quarter. Through the first few trading days of the second quarter, it's around the same amount. But how did investors do? Investors actually still benefited from diversification in the first quarter. So I can speak on behalf of, our portfolios, which, we manage for our clients. Most of those are globally diversified and diversified across company sizes as well. So, we're not just all large cap. We're not all S&P 500. If you look at a lot of clients talk about the concentration of the S&P 500 today, the Mag 7 or even the top 10 companies in the S&P 500, they're hovering around, over 30 to 35% of the index is concentrated in those top 10 companies. So in addition to the Mag 7, that includes JP Morgan, Berkshire Hathaway, and Broadcom is usually the less known. But our portfolios, when we build in our international holdings, emerging market holdings, small cap, real estate portfolios, those Mag 7 represent more like 20 to 25% of our equity holdings, so a significant reduction. And during the first quarter of this year, small cap stocks were positive, international stocks were positive, emerging market stocks were pretty much flat. So those sectors were outperforming the S&P 500. And then, of course, if you have bonds or fixed income in your portfolio, those performed well thus far in Q1. So investors did benefit from having some diversification in their portfolios. You're listening to The Ascent with Crestmont Private Wealth. This is Alec Walker, EVP of Financial Planning, talking about a market recap here in Q1 and looking ahead to Q2. Just a quick recap on the credit market on the bond side. So yields on the 10-year treasury, they did increase in Q1, and so that's why bonds were flat to slightly down during the first quarter of this year. Some of that has been the shift in rate cut expectations that we mentioned earlier. So again, the market's not expecting as much cuts from Fed rate hikes. So that was one of the reasons that may have driven the 10-year yield higher in the credit markets. But, all in all, I think the positive things that we have seen from bonds relative to equity markets over the last kind of 24 months as we've gone through some of the tariff chaos in April of 2025 and this recent geopolitical event is that bonds have been acting as a bit of a ballast. They've been holding their value relative to equities. Equity market was down about 15% during the tariff tantrum last year, and bonds were kind of flat to slightly up. So again, that diversification was coming into play, unlike what we saw in 2022, where we had stocks and bonds both down significantly. And then kind of bigger picture, kind of zooming out, one thing that we've been talking about recently in our investment committee meetings is the market seems to being down only 4%, given what's happening overseas, the Strait of Hormuz. I've had clients that reach out and are kind of surprised when they realize it's only down 4.5%. I think what investors and what the market is seeing, this is just our speculation, is the quick reaction that happened last year during the tariff tantrum, where the markets over one news social media post, the markets were up 10% within about 30 minutes. Investors don't want to get whipsawed like that. They're kind of staying invested, being hopeful on peace talks. And that's not to say that even if we get a resolution, that doesn't mean that the markets will immediately rebound, but at least some of those risks may be calmed a bit. So heading into Q2, what are we looking at? What is the key thing to watch for? Obviously, what happens in the Middle East, whether there's peace talks or continued conflict, how that affects oil prices, that's going to be a big driver. But one thing to kind of stay focused on, and we kind of try to remind our clients this, is as a reminder, we invest in businesses. And so far, earnings are still projected to grow. S&P 500 company earnings are projected to grow for this year. So far, analysts have not adjusted those earnings. I do think if oil prices remain higher for longer, it is possible that those higher input costs would then affect earnings. But going back to 2000, this was a really neat chart that we included in our newsletter. The correlation to S&P 500 price and earnings was a 96% correlation. So that is a very high correlation, meaning that when earnings rise, stock prices do generally seem to follow that. So let's kind of stay focused on, what are earnings doing? It'll be an interesting earnings season, seeing what the guidance is from these companies. That's something that we'll be focused on throughout our investment committee meetings. If you're a client of Crestmont, please stay on the lookout for some updates on some changes that we have been making through our portfolios. We hope to be kind of wrapped up with those changes this month as we've been kind of navigating the markets and looking for opportunities to make some tweaks. You're listening to the Ascent with Crestmont Private Wealth. I'm Alec Walker, EVP of Financial Planning. Did a quick market recap on what happened in Q1, gave you a quick outlook on what are kind of some things we're looking at for Q2. One thing I thought might be just kind of fun to touch on, baseball season is kicking up. I'm an Astros fan here in Houston, so I apologize if I use some Astros analogies to Rangers fan or non-baseball fans here. I thought it would be interesting to kind of compare a little bit of, baseball to, your financial life cycle. Baseball is a long season, 162 games. Sometimes they break it down into 9 separate 18-inning series is what you're playing throughout that long season. And I think that your financial planning life cycle can be the same. So whether, you're in the later innings of your own financial game or in the earlier innings, you may listen to some of these comparisons and think about your child or grandchild that's just getting started, or your parents or grandparents that are in those late inning games. Early on in your career, those first 3 innings, you just want to get started. You want to get on base, get base runners, on base percentage. Our heavy hitters come in and knock in those runs. And, not take too many risks. Like I said, being an Astros fan, I think about our great leadoff hitters like Craig Biggio, Jose Altuve. They're not afraid to come out swinging on that first pitch, and they can get lucky there and take one over the fence. But they're also susceptible to that low and away slider where they're swinging on their heels, getting too aggressive. So, being early it can be easy to take those risks, but you want to make sure you've got a good plan in place and avoiding those big strikeouts, those big mistakes. So focus on contributing to your accounts early, those trail builder accounts that we always talk about, staying consistent on your investments so that you've got some flexibility in the future. Now, as you kind of get middle into the game or middle into the career, that's where you've got some changes to make. Could be, a major windfall that's occurring, a big inheritance that comes unexpectedly that they're having to adjust from a tax planning perspective, an investment planning perspective, getting some kids through college, figuring out that budgetary decision. So these are all, very important things to consider. And then as we get later into the game, this is kind of, bringing in your setup man to lead into the closer, kind of the pre-retirement planning, making sure that you're protecting that lead that you could have generated earlier in the game. You're taking fewer risks, trying to make smart decisions. From a retirement standpoint, we talk a lot about the sequence of returns risk, meaning that significant losses early in retirement can really have an adverse effect on your long-term probability of success. So that's why we talk a lot about setting up our cash management plus strategies for clients. And then finally, kind of getting into the ninth inning, bringing in that closer to finish the game. Maybe that's working with, of course, hopefully you've got an advisor before then, but working with an advisor. Maybe that's bringing in an estate planning attorney to update things on your estate plan. And then also planning for extra innings. We hope to plan for clients for a very long retirement. And so we may be stress testing different longevities, planning to age 90, 95, 100. What are some things that we need to be doing if the game goes longer than expected? Who are we bringing in off the bench if we need to bring the catcher in to pitch, later into the retirement game? So those are all things that, we think about the full life cycle for clients. Early on in the game to late in the game, there's strategies that we could be implementing based on the changing situations. So whether you're rooting for the Astros, Rangers, or another team, hopefully you're excited for baseball season like I am as well. You're listening to The Ascent with Crestmont Private Wealth. This is Alec Walker. Hope you have a great rest of your day. Thank you.